Margaret checks her bank account on the morning of Wednesday, the 3rd of July. She expects to see her usual state pension payment, perhaps a little more this time given the increase she read about in the newspaper. Instead, the balance sits exactly where it was yesterday. Nothing has arrived. She checks again an hour later. Still nothing. Her energy bill direct debit is scheduled for Friday. The money needs to be there. By early afternoon, she phones the Department for Work and Pensions. After waiting on hold, she is told her payment has been suspended pending verification. The advisor cannot say when it will be released. Margaret is bewildered. She has received her state pension every 4 weeks for the past 3 years without a single problem. What has changed? Margaret is not alone. Across the country, thousands of pensioners are discovering that while July brings 3 important money changes, a state pension increase, a pension credit adjustment, and a clarification about winter fuel payment eligibility, there is one administrative detail quietly causing payment freezes. The mistake is not a scam, it is not fraud, and it is not a permanent loss of entitlement, but it can stop money from reaching bank accounts for weeks, sometimes longer. And many pensioners do not realize they have made the error until the payment simply fails to arrive. The 3 July changes are designed to help, but one overlooked requirement could prevent the money from reaching your account at all. What most pensioners have not been told is that even if you qualify for the increase, there is one detail that could stop everything. And the letter warning you about it may have already arrived. July is traditionally significant for UK pensioner finances, but understanding what is actually changing requires clarity about 3 separate updates that do not always work the way people assume. The first change is the state pension increase. The state pension rises each April in line with the triple lock mechanism, a commitment that guarantees the pension increases by whichever is highest, inflation measured in the previous September average earnings growth, or a minimum of 2.5%. For most pensioners, this increase appears in their April payment. However, those who reached state pension age in April, May, or June receive their first payments later in the year. For them, July represents a normal payment cycle, but one that now includes the uprating built in from the start. Additionally, some pensioners who were underpaid earlier in the year may receive a correction in July. The crucial point is this: the state pension increase is automatic. You do not need to apply. The DWP calculates it based on your existing records. The second change involves pension credit. This is a means-tested benefit designed to top up the income of pensioners over state pension age who are living on very little. Each year, the thresholds, the income levels that determine eligibility and payment amounts, are adjusted, typically in line with inflation. A threshold increase means some pensioners who previously earned slightly too much to qualify may now become eligible. However, this is where the critical distinction emerges. Pension credit is not automatic. Even if you become newly eligible because the threshold has risen, you must still apply. The DWP will not contact you to tell you that you now qualify. Thousands of pensioners miss out on this support simply because they do not realize they should apply. The third change relates to winter fuel payment eligibility. Although these payments are made in November and December, the DWP reviews who qualifies during the summer months. In July, many pensioners receive confirmation letters stating whether they will receive a winter fuel payment and for how much. These letters also often include requests to verify identity, confirm your current address, or update bank details. This is where the administrative tension begins. These 3 changes affect different groups of pensioners differently. A single pensioner receiving only the state pension may see a small increase, but may not qualify for pension credit if their total income exceeds the eligibility threshold. A low-income pensioner already receiving pension credit will see both their state pension and their pension credit adjusted. A pensioner living abroad may qualify for the state pension increase, but may not qualify for the winter fuel payment, depending on which country they live in. The 3 changes sound straightforward when described separately, but the way they interact with each other and with your personal circumstances is where confusion begins. And that confusion is exactly what leads to the mistake that can freeze payments. To understand how that happens, we need to look at how the current system actually operates and where its weaknesses lie. To understand why payments can suddenly stop, it helps to understand how the 3 benefits are administered. Because each one operates differently, and the rules governing each are more precise than many pensioners realize. The state pension is paid by the Department for Work and Pensions every 4 weeks, directly into a bank account, building society account, or post office card account registered with the DWP. Your specific payment date is determined by the last 2 digits of your national insurance number, which is why different pensioners receive their payments on different days of the week. The amount you receive depends primarily on your national insurance contribution history, the number of qualifying years you have built up over your working life. It also depends on whether you reached state pension age before or after the 6th of April 2016, because those 2 groups fall under different systems. Pensioners who reached state pension age before that date receive the basic state pension, which may be supplemented by additional entitlements, such as SERPs, or the state second pension. Those who reach state pension age afterwards receive the new state pension calculated on a different basis. Crucially, the state pension is not means tested. Your savings, other income, and household composition do not affect the amount. However, the state pension is taxable income. If your total income from all sources exceeds the personal allowance, currently £12,570, you may owe tax on a portion of it. Pension credit works quite differently. It is a means-tested benefit designed specifically to provide a minimum income floor for pensioners over state pension age who are living on low incomes. It has 2 components. The first is guarantee credit, which tops up weekly income to a minimum threshold. Figures vary and should be verified against current DWP rates before the script is finalized. The second is savings credit, a smaller additional payment available only to pensioners who reached state pension age before April 2016 and who have made some provision for retirement through savings or a private pension. Pension credit is calculated by assessing your total income, including state pension, any private or workplace pension earnings, and certain other benefits. Savings above £10,000 are treated as generating a notional weekly income, which is counted against the threshold, even if the savings are not actually being drawn upon. Pension credit is not paid automatically. It requires an application, and many pensioners who are entitled to it never claim it. One significant feature is that it can be backdated by up to 3 months, meaning eligible pensioners who apply late may still receive money owed from earlier in the year. The winter fuel payment operates on a different timetable entirely. It is a one-off annual payment made to most people over state pension age who are living in the United Kingdom. The amount varies depending on age and household composition, and the payment is made automatically in November or December. However, eligibility is assessed using information from a qualifying week in September, typically the 3rd week of that month. To qualify, you must be living in the UK during that week. Pensioners living in certain European Economic Area countries may also qualify, though the rules depend on the specific country and individual circumstances. What connects all 3 systems is the DWP's reliance on accurate, up-to-date information. If your bank details change, if you move to a new address, if your marital status changes, or if your income changes, you are responsible for informing the relevant part of the DWP promptly. The department increasingly uses data matching with HMRC and local councils to detect discrepancies, and when something does not match, payments can be suspended while the issue is investigated. A suspension does not mean the money has been permanently lost. It means the DWP has paused the payment until your information can be verified. But the pause can last weeks, and during that time, the money simply does not arrive. The system is designed to be automatic, but it depends entirely on one assumption, that your details are current, accurate, and complete. And that is precisely where the July mistake begins. The 3 July changes each carry their own set of conditions, and understanding those conditions is where the real story begins. Because while the headlines suggest these updates will simply deliver more money to more pensioners, the reality is considerably more layered than that. Start with the state pension increase. For most pensioners, the uprating that takes effect each April will already be reflected in their payments by July. But July is not an irrelevant month. For pensioners who reached state pension age in April, May, or June, perhaps someone who turned 66 during that period, July may represent one of their first full payment cycles, now including the increased rate from the outset. For others, July may bring a correction, if an earlier payment was calculated incorrectly. And for those who have been waiting for a long-standing underpayment to be resolved, July is sometimes the month when arrears finally arrive. The increase itself is automatic. No application is needed. The DWP calculates it using existing records. But here is where the first hidden condition appears. The payment is only automatic if the account registered with the DWP is open, active, and correctly recorded. If anything is changed on that side, the automation breaks down entirely. The pension credit changes introduce a different layer of complexity. Each year, the thresholds used to calculate pension credit eligibility are reviewed and typically increased. When the guarantee credit threshold rises, it means the income level below which a pensioner qualifies also rises. In practical terms, some pensioners who previously sat just above the eligibility line may find that the threshold has moved upward to meet them, making them newly entitled to support. This sounds straightforward, but the critical point is that pension credit does not find you. You must find it. The DWP will not write to every pensioner whose income now falls below the adjusted threshold. There is no automatic enrollment. If you become newly eligible in July and do not apply, the entitlement simply sits unclaimed. Estimates from organizations including Age UK have consistently suggested that billions of pounds in pension credit goes unclaimed nationally each year, and a threshold adjustment, however welcome, does nothing to close that gap, unless pensioners are aware they should act. For those already receiving pension credit, the picture shifts again. The July state pension increase, while beneficial in isolation, can create an unintended interaction. Because pension credit is calculated by subtracting your total assessed income from the relevant threshold, a higher state pension means your income rises. If your income rises, your pension credit entitlement may fall by a corresponding amount. The net effect for some low-income pensioners can be almost neutral, gaining a few pounds on the state pension while losing a similar amount from pension credit. This is not an error. It is how a means-tested system is designed to operate. But it surprises many people who expected both payments to increase simultaneously. The winter fuel payment adds a third dimension. The payment itself is made in November or December, but summer is when the DWP reviews eligibility and sends letters to pensioners confirming whether they qualify and for how much. Some of those letters do more than confirm eligibility. They ask pensioners to verify their identity, confirm their current address, or update their registered bank details. These are genuine letters from the DWP. But they arrive at a time when scam awareness is high, and many pensioners quite reasonably have grown cautious about correspondence that asks for personal information. The consequence of ignoring a genuine DWP letter can be severe. If the department does not receive a response by the specified deadline, it may treat the account as unverified and suspend not only the winter fuel payment, but linked benefits, or in some cases, the state pension payment itself. This brings us to the one mistake that connects all three changes. It is not a single dramatic error. It is an accumulation of small administrative oversights, any one of which can trigger a payment freeze. A pensioner who switched bank accounts in the spring but did not inform the DWP will find that the July state pension payment is sent to a closed account bounces back and triggers an automatic suspension. A pensioner who started receiving a small workplace pension in May but did not report it to the Pension Credit Service may find that the DWP's data matching systems detect the discrepancy, freeze the pension credit payment, and open a review. A pensioner who received a verification letter in June but assumed it was a fraudulent attempt and placed it in the recycling bin may find their July payment simply does not arrive, with no immediate explanation. None of these people intended to cause a problem. None of them committed fraud. But in each case, the payment is frozen until the DWP receives the information it needs. The rule changes are designed to increase support, but they also increase the number of verification touchpoints. And if your details are not current, or if you ignore a letter asking you to confirm them, the payment can be frozen before it ever reaches your account. Understanding the financial consequences of that freeze is what matters most. When the 3 July changes work as intended, the financial effect on a pensioner's household can be genuinely meaningful, not transformative, but significant enough to ease the pressure that many people on fixed incomes feel every single month. The state pension increase delivered through the triple lock mechanism typically adds a modest but real amount to each payment. The precise figure depends on the uprating percentage confirmed for the relevant year and should be verified against official DWP figures before this script is finalized. As a general illustration, an increase of several pounds per week accumulates considerably over 12 months. Received every 4 weeks, even a modest weekly rise translates into a noticeably larger payment each cycle, and across a full year, the additional income can reach several £100s. For most pensioners, this money arrives without any action required. It simply appears in the bank account on the usual payment date. However, it is worth noting that the state pension is taxable income. Pensioners whose total annual income from all sources, state pension, private pension, rental income, or part-time earnings, exceeds the personal allowance, may find that a portion of the increase is effectively absorbed by a tax liability. The gross increase and the amount that genuinely improves day-to-day life are not always identical. The pension credit adjustment carries a different kind of financial weight. For a pensioner who qualifies for the first time because the guarantee credit threshold has risen, the value extends well beyond the weekly payment itself. Pension credit acts as what is sometimes called a passport benefit. Receiving it can unlock entitlement to a range of additional support, including help with council tax, housing benefit, free National Health Service dental treatment, and assistance with heating costs. The combined value of these linked entitlements can be substantial, potentially adding thousands of pounds annually in support that a pensioner living just above the old threshold would never have received. This is precisely why unclaimed pension credit represents such a significant financial loss for those who are eligible but unaware. The winter fuel payment, though, a one-off annual amount, carries particular weight for pensioners on the lowest incomes. For someone managing a tight household budget through the colder months, the difference between receiving that payment and not receiving it can be the difference between heating the home adequately or making difficult choices about which bills to prioritize. Current rates should be confirmed against DWP guidance for the relevant year before finalizing this script. Now consider what happens when the same pensioner makes the administrative mistake described earlier. The financial consequences do not arrive all at once. They accumulate gradually, and by the time the full picture becomes clear, the damage to the household budget can be surprisingly severe. In the first week or two, the missing payment causes confusion rather than immediate crisis. By the third or fourth week, the effects become practical and urgent. Direct debits for energy, water, council tax, or rent begin to fail. Banks may apply charges for returned payments. A pensioner who has little or no financial buffer may begin drawing on savings, or in some cases using credit to cover essential costs. If pension credit is the payment that has been frozen, the linked benefits that depend on it, housing benefit, council tax reduction, may also be suspended, compounding the pressure considerably. Resolution, when it comes, usually includes the payment of arrears in a lump sum. The money that was owed is eventually paid, but the weeks of disruption cannot be undone. Late payment fees, failed direct debits, the stress of navigating the DWP while managing an uncertain household budget. These carry a real cost that never appears in any official calculation. The difference between receiving the July changes and having your payment frozen can come down to one letter, one phone call, or one piece of outdated information. Which means the most important question now is a simple one. What should pensioners actually check before that situation arises? Knowing that a mistake can freeze a payment is only useful if you know what to do about it. The good news is that for most pensioners, the steps required are straightforward, and many people will find they have nothing to correct at all. But checking costs nothing, and the peace of mind it provides is worth considerably more than the few minutes it takes. If you receive only the state pension, and nothing about your circumstances has changed recently, same address, same bank account, same household, then in all likelihood, your July payment will arrive as expected, reflecting any applicable increase. Your main task is simply to check your bank statement when the payment is due and confirm that the amount looks right. Compare it with your previous payment. If it is broadly similar or slightly higher, that is what you should expect. If nothing arrives, or if the amount appears significantly different without explanation, that is the point at which you should contact the pension service directly. If you have changed bank accounts at any point this year, This is the most urgent action you need to take. Do not wait until July to discover the payment has failed. Contact the pension service as soon as possible. Before calling, have your national insurance number ready, along with your new bank account sort code and account number. The pension service helpline number is 080073-10469, though you should verify this against gov.uk before the script is finalized, as contact details can change. Allow enough time before your next payment date for the update to be processed and confirmed. If you receive pension credit, take a few minutes now to consider whether anything in your financial circumstances has changed since you last updated the DWP. Has a private or workplace pension begun paying out? Have your savings increased above £10,000? Has a partner started receiving additional income? Any of these changes can affect your pension credit entitlement, and the DWP's data matching systems are increasingly effective at detecting discrepancies. Reporting a change yourself is always preferable to having the DWP discover it independently, because voluntary reporting is handled as an administrative update, while a detected discrepancy can trigger a formal review and a payment freeze. The pension credit helpline number is 0800-9912-34. Again, to be verified against current gov.uk guidance. If you have recently received a letter from the DWP asking you to confirm your identity, your bank details, or your current address, the single most important thing is not to ignore it. Scam awareness is important and valuable, but genuine DWP correspondence can look official, precisely because it is official. If you are uncertain whether a letter is genuine, do not use any phone number printed in the letter itself. Instead, visit gov.uk and use the verified contact details listed there to call and confirm whether the letter is authentic. Once confirmed, respond before the deadline stated in the letter, and keep a copy of everything you send. If you live abroad or have recently moved abroad, contact the International Pension Center to update your address and bank details, and check whether the state pension increase applies to your country of residence, as uprating rules vary internationally. For everyone, a few broader habits are worth establishing now. Keep your DWP award letters somewhere accessible. Make a note of your payment dates so you notice immediately if one is missed. If you find the process of contacting the DWP difficult, do not hesitate to ask a family member, a carer, or a trusted friend to help. Organizations including Citizens Advice Age UK and Independent Age offer free, confidential guidance to pensioners navigating benefit questions, and their advisors are experienced in dealing with exactly these situations. One final and important caution: the DWP will never telephone you unexpectedly and ask for your bank details, passwords, or a one-time security code. If you receive such a call, end it and report it to Action Fraud on 0300-123-2040. Genuine DWP updates arrive by post, and genuine payments never require a fee to be released. The most important step is not to wait until the payment is missing. Check now while there is still time to resolve anything before July arrives. Margaret. Quote, S payment was eventually reinstated after 3 weeks of uncertainty, repeated phone calls, and the quiet stress of watching direct debits fail while waiting for a resolution. The DWP confirmed her new bank details, processed the update, and paid the outstanding arrears in a single lump sum. The money she was owed arrived. But the 3 weeks it took to get there had already left their mark. A missed bill, a late payment fee, and an experience that reminded her just how much she depended on that payment arriving on time, every time. Her situation was not caused by a government policy failure. The July increase she was entitled to had been calculated correctly. The DWP had processed it accurately. The problem was a single piece of outdated information, a bank account she had closed in May, which she had simply assumed the DWP would somehow already know about. That assumption cost her 3 weeks of financial stability. This is the real lesson buried beneath the headlines about July's 3 money changes. The state pension uprating, the pension credit threshold adjustment, and the winter fuel payment eligibility process represent genuinely valuable support for millions of older people across the country. But every one of those payments depends on the same quiet assumption that the information held by the DWP reflects your actual circumstances today, not your circumstances from 6 months or 2 years ago. When that assumption holds, the system works. When it does not, payments stop, households struggle, and the resolution process places exactly the kind of administrative burden that many pensioners are least equipped to manage alone. The next payment date is approaching. The question is not whether the money is coming, it is whether your account is ready to receive it. If you have checked your bank details recently, read your DWP letters carefully, and kept your circumstances up to date, you have done what matters most. If you have not, there is still time. Have you received any letters from the DWP recently asking you to confirm your details? Has your July payment changed? Let us know in the comments below, and if this information could help someone you know, please do share it with them.